Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello, everybody, and welcome back to the 360 Money Matters podcast. I'm Billy, and I'm joined by my co-host,
Andrew. Good to be back for another podcast again.
Andrew, it's always good to be back recording the podcast with you, mate. How have you been?
Yeah, everything's going well. Things are opening up here in Melbourne. We're coming out of lockdowns. The weather's looking nicer. It's definitely a sign of brighter times ahead.
Yeah, absolutely. Very exciting times, mate. Exciting topic today. On our podcast, we're doing a little bit more of a deeper dive into the investment aspect of financial planning. And today we've got a bit of a deeper dive discussion on fund managers.
Yeah, so today what we're going to be doing is comparing and contrasting a couple of different methods that you can invest. How do you do it, whether it's directly with the investment or whether that's through a fund manager. We're going to be comparing and contrasting some of the benefits and some of the costs of doing it in either manner.
Beautiful. Let's get right into it. And hopefully, like always, we provide a lot of value for our listeners and you get some more insight into how we think as financial planners and some of the things that we do for our clients day in, day out. But Andrew, I guess in its simplest form, over to you. What is a fund manager and what do they do?
So look, a fund manager is basically a professional manager, a professional that pulls together money from various sources. Now that can be from people that are investing through superannuation, through another portfolio, and they invest on behalf of a client. Basically, if you consider it in sort of the most simplest form, and sort of the easiest way that I find explaining something is by comparing it through an example. A fund manager will generally invest in a variety of assets, but just for today's exercise, to keep it really simple, let's imagine that a fund manager is only investing in one asset. Let's say the fund manager is purchasing a specific stock, so one stock. Now, obviously, that's never going to happen because there's no point in doing so. But by investing through a fund manager, you're investing an amount of money and a whole bunch of other people are investing an amount of money in that fund manager, and that fund manager is purchasing that specific stock. Now, you don't need to purchase the exact units in terms of the stock purchase price. You can purchase far smaller amounts, but basically they're the professional manager that's doing the purchasing on your behalf. All that you're doing is investing in that fund manager. You compare that with investing directly. You buy that exact same stock, whether that's through a stockbroker, whether that's through a trading platform, whatever it is, but you purchase that stock directly rather than through a professional manager. In that long-winded way that hopefully has answered what a fund manager is. Now, they can vary. So some will invest in Australian stocks, some will invest in international equities, some will invest in property, in infrastructure, in bonds. So a variety of asset classes. You're talking about thousands of fund managers available to investors. So there's really an endless supply of options.
So just to summarize, Andrew, so I've got it really clear in my head. It's basically a professional investment manager that's investing in a particular asset class. So there's fund managers for pretty much every asset class that's available and pooling a whole group of investor money together and investing that into a investment that they deem to be worthy, that meets the objectives of the investment, I guess, mandate or criteria of what they're looking at from their perspective.
Yeah, exactly right. And as the investment goes up and down in value, as does your ownership portion within that fund manager, and as they pay dividends and pay income, then you get a small portion of that as well, relevant to your percentage holdings also.
I guess the most relevant thing to probably pivot to now is, what's the benefit of investing in or using a fund manager rather than doing it directly?
Look, there's various benefits and it ultimately depends on what asset class you're investing in and sort of what you're trying to achieve. If you consider a fund manager, let's say, that's investing in a larger asset class, so you're talking property, you're talking infrastructure, you're talking bonds, you're talking assets that generally speaking, you need a significant amount of money in order to be able to invest in, you can get into those investments with a relatively low cost. You don't have to cough up the deposit for a property. You don't have to cough up the stamp duty for a property. You can own a small portion of a property without having to have a huge amount of money and be able to reduce that into smaller bite-sized pieces of your investment and still have exposure to that asset class.
Yeah, so the barriers to entry on particular types of investments are quite high just by their very nature. And being able to invest through a fund manager not only gives us access to those with a smaller amount of money that we've got. But yes, the other thing that I tend to concentrate on, these types of opportunities that fund managers get aren't actually available to the regular investor. It's just because of the sheer size and the complexity of the investments, your regular investors don't get a look in. So
yeah, exactly. I mean, you consider an infrastructure asset, whether that's a water line, whether that's a gas line, a toll road, there's very few people that are going to have the funds available. And even if they do have the funds available, which is unlikely, the opportunity to purchase that asset in its entirety. And so having access to really assets that you ordinarily wouldn't have the ability to invest in, even if you did have the funds.
I guess the other benefit too, which is usually overlooked and can be understated, is the specialist knowledge of the investment manager who's making that decision, or a group of portfolio managers that are running that managed fund, the specialist knowledge that they've got in that particular field. So we spoke about asset classes before, where you've got fund managers available for different asset classes right across the board, but the investment managers, the people that are making the decisions about where to invest the money, they're specialists in that particular asset class that they're actually looking at. And we're getting access to that, essentially a professional investment manager in that particular asset class that we're getting exposure to. So that can't be understated when we're looking at fund managers as well.
Yeah, absolutely. Absolutely. I mean, it's really the job of the fund manager to review the underlying investments, review the quality of the assets. And so you're basically taking away, obviously, an element of control from yourself. However, what's replacing that is the specialist knowledge and that sort of intricate details into the investments and the decisions that are underpinning those investments as well. So yeah, definitely can't be understated.
Well said, well said. And I mean, it sounds great. You get access to, yes, world-class assets that you wouldn't ordinarily get exposure to because of the sheer size and the sheer volume of them. Plus you're getting a professional investment manager looking at this, making investment decisions, when to buy, when to sell, what assets to get into. What are some of the costs associated with accessing this, and also being able to access it with a reasonably small amount of money from an investor's perspective? But what are some of the costs associated with it, Andrew?
So there's a couple of costs involved when you're purchasing assets in fund managers. So there's an annual or a funds under management costs, generally speaking. So an MER, generally that's a percentage of the fund that are invested. So they'll take a fee, whether it's charged on an annual basis, a monthly basis, on whatever basis that the fund manager chooses to charge. In addition to that, there's usually buy-sell costs as well. So every time you buy into an asset, there's a small cost. Every time you sell out of that asset, there's a small cost as well. They range. So there's some fund managers that you're talking about MERs of 0.2%, and there's some fund managers where you're talking about MERs of 2.5%. It ultimately ranges depending on the advice, the complexity of the fund manager and what assets they're investing in and the approach that they're taking. It will also change depending on the investment or how the fund manager will do the investment as well. Completely sort of separate topic that we'll probably, have as another topic in one of the podcasts, but whether it's an active fund manager that's actively trying to overperform the market or an index fund manager that's just following and tracking the market will ultimately determine the cost as well.
Yeah. And not that I want to get into a discussion about fees, because there's been push and a constant push and a race to the bottom in terms of fees. But when you're talking about the MER, so the management expense ratio that the fund managers do charge a client to use their fund or invest in their fund and get access to their specialist knowledge, I mean, some of those numbers from a cost perspective, considering what you get, I think it's pretty reasonable.
Yeah, I mean, look, it's ultimately cost is irrelevant without having the value piece. It's exactly the same as just purchasing the cheapest property in an area. Just because it's the cheapest asset doesn't mean that it's the best thing or the right thing to be investing in. You need to overlay the benefit, the expected yield, the expected growth out of that asset in order to determine the value of that cost as well.
Yeah, no, well said, well summarized. I mean, look, some of the other benefits that you get with investing through a fund manager, obviously we spoke about the specialist advice when you're doing it. But from a compliance and a taxation perspective as well too, Andrew, you want to run us what we get from a fund manager's perspective when we're investing clients' money through a fund manager?
Yeah, so when you're investing through a fund manager, usually that's done through a platform. It can be done directly, but irrespective of how you're doing it, you're getting a tax report and the tax summary at the end of it. And so it should be as simple as providing that tax summary to your accountant or plugging that into your tax return when you're doing it every year. And it's quite as simple as that in determining the tax liability at the end of the year. It's fairly easy and simple to run when you're looking at it from a tax perspective or when you're trying to determine the tax position. And ultimately, if you're doing it directly, and again, just using shares as an example, you're usually having to go in, determine which shares you purchased at what time, what the capital gain is on that, whether there were any franking credits. There's significantly more work when you're doing it directly in order to determine the tax liability at the end of the day, as opposed to doing it through a fund manager as well.
I don't think we can downplay that convenience, Andrew. I must say, I mean, I'm going through preparing my tax return at the moment with my accountant. I get access to all of these reports, which makes it a lot easier. I must say, though, if I needed to keep my own records and track everything and calculate it, it would be an absolute disaster. So it's a small price to pay in order to get access to that convenience, and definitely makes life easier for my accountant when we do our tax return, that's for sure.
Absolutely. If your accountant's life is easier, then it definitely means that it's a little bit lighter on the bill.
Less fees, exactly right. Going back to the piece about being able to access a certain type of investment through a fund manager rather than going direct. To put this into some context, I've seen direct investments needing to have into the type of investments that a fund manager invests in the vicinity of $500,000 in order to invest directly into a particular investment option. Something like that coupled with going through, or compared to going through a fund manager where you can literally do it with a couple of $100 if you like.
Yeah,
exactly. It's night and day.
So really, you're expanding open your available opportunities to be able to invest. So you're not limited by geographic location. You're not limited by the amount of funds that you have to invest. You can do a very small amount and with relative ease. I mean, you consider an asset like emerging countries, investing in shares in emerging countries, trying to find a platform that's going to allow you to do that and invest directly, trying to find the specialist knowledge in those assets is difficult. And it's not to say that it's impossible, but having that at your fingertips through a fund manager, and obviously selecting the right fund manager and the right type of investment is imperative, but you definitely can't underplay that, or you can't sort of understate the opportunity that's available there. And I think the other thing as well is your ability to diversify. I mean, take us through that, Billy. There's some diversification benefits when you're investing through a fund manager as well. When you're investing through fund manager, there's the ability to, with a small amount of money, spread your investment across, let's say, multiple shares. For instance, you're not having to buy with a few $100 only one share. There's multiple options or multiple shares and exposure that you can have with a relatively small amount of money.
No, you're absolutely right. Investing in fund managers does give you the ability to diversify your investments. I mean, thinking about that investment decision as an individual, take the shares that you're going to buy. You need to make a decision with the amount of money that you've got, what shares you do spread them through or around, and then you need to think about what parcel size or what amount of shares that you do buy. Whereas if you invest that through a fund manager, they're diversifying on your behalf anyway across the entire fund in that asset class that they're investing in. You do get access to a greater level of diversification. And that's one of the benefits and one of the key cornerstones that we talk about all of the time with investing. It makes the investing process a lot easier because you don't have to be as active with your investments as well too, because you're paying the fund manager through the MER. So that fee that you are paying them, they make those decisions on behalf of the investors that are invested in that managed fund. So that makes that whole process a hell of a lot easier. And the other thing too, going back to the direct investment and the large amount of money that you need in order to get into these things, if you're putting in a large amount of money, and look, ordinarily, if you're putting in that amount of money, maybe you've got a bucket load of money, but by doing it through a fund manager, the other thing that you can do is you can do it incrementally over a longer period of time and actually dollar cost average with smaller amounts of money. So you're not needing to get your investment decision right all of the time, trying to time and pick the investment to get that investment at a really good price.
Yeah, exactly right. And you're not having to sort of leave money sitting in cash until you save up enough money to be able to purchase another parcel of those direct assets that you want. So you consider whether it's a property, whether it's share investments, whether it's infrastructure investments, whatever it is, you're not having to save up in order to have, whether it's a few $1,000s or a few $100,000, but then purchase a parcel of assets. You're able to put 200 a week or 500 a week or whatever the number is on a regular basis when you're doing that through a fund manager, which ultimately can reduce the risk in investing because having to time the investments and you're averaging and smoothing out the buy price of your investments as opposed to all of that happening at one particular point in time.
Well summarized. And Andrew, from a taxation perspective, re-franking credits, capital gains tax, managing that, you want to run us through some of the advantages of investing through a fund manager when it comes to those things?
Yeah, I mean, look, when you're investing through a fund manager, especially with, franking credits and the capital gains events, there can be some implications. So a fund manager is not going to look at your personal income. They're not going to time when they purchase or sell an asset. They're just going to purchase and sell an asset that they think is no longer the best and most appropriate asset, which may not necessarily be the best case scenario for you. So when you're investing directly, you have the ability to time when you sell that asset, when you incur that capital gain. The amount of times that we've sat in front of clients and they've been holding onto a parcel of shares for the last 20 years. And even though they may not be the best performing assets or the best shares that they can invest in, the recommendation is to continue holding them because the capital gains event is going to be too large.
Good problem to have, I reckon.
Yeah, look, ultimately, we all want to reduce our tax as much as possible. But if you're paying tax, it means that you've made money. And so it's definitely a better problem than not.
This is true.
When you're investing directly as opposed to through a fund manager, you've got that ability to time the capital gains events, control the franking credits, and in essence, be able to decide what is the best asset to be holding for you rather than just looking at what is the best and most investable asset at a particular point in time. That is definitely a consideration. It's not just all benefits when investing through a fund manager. There are times where you'd want to control those investments and invest directly. It's certainly one for the direct investment team.
Yeah, and I guess it's getting the balance right between what your goals and objectives are as an investor, how much money you've got to invest, what your appetite is in order to be active with your investments as well too, how comfortable and confident you feel making those investment decisions yourself. So yeah, it's good that we've had a look at the other side of the fence. It gives us a little bit more context around the direct ownership versus just going through a professional fund manager and getting them to do it from their end. So yeah, a few things to consider when taking it or when looking at it from that perspective as well too. Andrew, what about something like say property and owning it directly and being able to control that asset and doing improvements to it? You can't obviously do those sorts of things through a fund manager.
I mean, when you're investing through property fund manager, you're kind of just locked into whatever they're doing. Most fund managers will usually just hold on to a property and do the maintenance on it, but that's about it. But when you own a property directly, you've obviously got the ability to improve that property. So you can do renovations in order to improve the capital value. You can do some developments on that property. There's various things that you can do to improve the value of the property, the attractiveness of the property from a rental income and a yield perspective that you just don't have the same ability to control when you're doing so through a fund manager.
Yep. Yeah, well said. And I guess that's really just applicable to the property asset class with the rest of the asset classes that we can invest in. Unless it's infrastructure, and that means you've got a bucket load of money and what we're talking about is probably irrelevant anyway. So, but yeah, mainly just touching on the property category there in terms of being able to control it, value add, improve, develop it.
Unless you're Warren Buffett and you've got enough money to purchase a stock directly as well and improve that asset in that means, but I don't think that's what we're comparing.
A company,
yeah, exactly.
Well, folks, there you have it. Thank you for your time. Hopefully we gave you some good insight into what fund managers do and the benefits and advantages of holding or using fund managers and holding assets through them.
Yeah, ultimately, strongly advise receiving advice on this area, because there are some times that direct ownership in assets is the right way to go. Other times, doing it through a fund manager is simpler, easier, and the right manner. And so making sure that you receive advice on this area as to what's the best thing to do in your specific situation is really important.
Nicely summarised. Andrew, thank you as always.
Thank you, Billy. It was always a pleasure, and thank you all for listening.
We'll catch you on the next one.
Bye.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.